So you're selling products online in India, right? Then you've definitely heard the term GST thrown around. And yeah, it can sound pretty complicated. But don't you worry. We're going to break down everything you actually need to know right here, right now. Let's get into it. All right, first things first. Let's blow up the biggest myth out there. You see a local shop, right? They only have to worry about GST once they hit, say, 40 lakh rupees in sales. But for you, as an online seller, it's a whole different ballgame. And I mean completely different. It doesn't matter if you sell something for 10,000 rupees or even just 10 rupees. The second you make that first sale online, boom, GST registration is mandatory. There's no minimum, zero.
So, how are we going to tackle all of this? Simple. We've broken it down into 5 easy steps. First, we'll cover the absolute first requirement for GST. Then, we'll walk through what happens with your very first sale. After that, we'll get into the money, the credits, the deductions, the whole shebang. Fourth, we'll demystify the process of actually filing your returns. And finally, we'll wrap up with the most crucial takeaways that you just can't afford to miss.
Okay, let's jump right into part 1, the first condition. This is ground zero. It's all about getting registered and understanding the fundamental rules that are non-negotiable for online sellers. So why is there such a huge difference? Well, it all comes down to one thing, Section 24 of the GST Act. This section basically says that for certain businesses, turnover doesn't matter. You have to register. And guess who's on that list? Yep, anyone selling on an e-commerce platform. The takeaway here is simple but so important. If you sell online, you need GST. From day one, period.
Now you might be thinking, wait, I've heard about this easy option, the composition scheme, for small businesses. And you're right, it exists. It lets you pay a simple, low tax rate. But, and this is a big but, for online sellers, it's a no-go. It's just not available. You have to go with the regular, full GST scheme. No shortcuts on this one, unfortunately.
All right, so you've done the paperwork, you're officially registered, awesome. But now comes the exciting part. You've made your first sale. So, what now? That brings us to part 2, handling the GST on that very first sale, which means charging the right tax and creating the right invoices. How you charge GST is actually pretty straightforward. It all depends on where your customer is. If you sell to someone in your own state, let's say you're in Rajasthan and so is your buyer, the GST gets split in 2, CGST for the central government and SGST for the state government. But if your customer is in a different state, say you're shipping from Rajasthan to Maharashtra, then you charge one single tax called IGST. The cool thing is, the total tax rate for the customer is the same either way. It's just a difference in how it's broken down on the back end.
Okay, but when do you actually owe the government this money? This is super important. It's all about something called the time of supply. Let's look at this timeline. The customer places an order on April 1st. You deliver it on April 5th, but maybe the platform doesn't pay you until April 20th. So when is the GST due? April. It doesn't matter when the cash hits your bank account. The transaction happened in April, so the tax is due for April. Simple as that.
Now, platforms like Amazon or Flipkart will often generate an invoice for you, which is great, but, and I can't stress this enough, the buck stops with you. You are 100% responsible for making sure that invoice is correct. It needs to have your GST number, the product's HSN code, that's just a standard way to classify products, the right GST rate, and the place of supply. If there's a mistake, the taxman isn't going to call Amazon. They're going to call you.
All right, let's get to the part we all care about, the money. This is Section 3, all about managing the cash flow and, more importantly, the credits and deductions that actually save you money. Okay, listen up because this is probably the best part of the whole GST system. It's called Input Tax Credit, or ITC. It's basically a game changer. Imagine this. You collected, say, 5,000 rupees in GST from your sales. But on the flip side, you spent 1,000 rupees in GST on your business expenses, like your packing materials. With ITC, you get to subtract that 1,000 you already paid. So you only owe the government the difference, which is 4,000 rupees. This is huge. It means you're not getting taxed on your taxes.
But, you know there was a but coming, right? It's not a free-for-all. You can't just claim this credit on everything.
This is where the idea of blocked ITC comes in. It's a list of things you can't claim credit on. So things that are directly for your business, like courier fees or packing tape, absolutely you can claim that. But stuff like ordering lunch for the office or booking a hotel for a business trip, nope, the government blocks the credit on those. Knowing what's allowed and what's not is absolutely crucial.
Okay, another thing you're going to see in your payment statements is a little 1% deduction called TCS,
which stands for tax collected at source. The first time you see it, you might freak out a little, but don't. It's totally normal. The platform is required by law to collect this 1% from you and give it to the government. But here's the good part. That money isn't bond. It sits in your government account, like a credit, and you can use it to pay off your final GST bill. So it's really just a prepayment.
We all know returns are just part of the e-commerce life. So what about the GST you paid on a product that a customer sent back? Well, there's a process for that, and it's called a credit note. You just issue one of these, and it officially cancels out the original sale. More importantly, it reduces your GST bill for the month, so you get that tax money back. It ensures you're not paying tax on money you had to refund.
So, you're keeping track of your sales, you know about your credits, you're handling returns. Now you've got to tell the government all about it. That brings us to part 4, the actual process of filing your returns and paying your tax.
Every single month, there are 2 main forms you need to know: GSTR1 and GSTR3B. Think of it like this. GSTR1 is just for reporting. You're basically telling the government, hey, here's a list of every single sale I made this month. That's it. Then comes GSTR3B. This is the payment form. It's a summary where you take your total tax, subtract all your input credits, and pay the final amount. So one is for telling, the other is for paying.
And that brings us to our final and maybe most important section. These are the key things you need to remember to stay out of trouble and even use the GST rules to your benefit. You have to remember, the tax department is getting data from 2 places, you and the marketplace, like Amazon. Now, what do you think happens when those numbers don't match up? Let's say you report sales of 9.5 lakhs, but Amazon's data says you sold for 10 lakhs. That difference? It's a massive red flag for the tax authorities. Honestly, this kind of mismatch is probably the #1 reason online sellers get a scary notice from the government. So please, always match your numbers. And trust me, those notices aren't just friendly letters. They come with real penalties. For something as simple as a mistake on an invoice or claiming the wrong credit, you're looking at a minimum penalty of 10,000 rupees. It really pays to get this stuff right from the very beginning. It'll save you a ton of cash and a whole lot of sleepless nights.
But hey, it's not all doom and gloom in paying taxes. Sometimes you can actually get money back from the government. Under a rule called Section 54, you can file for a refund. This could be because you exported some goods, or maybe that 1% TCS they collected ended up being more than what you actually owed. The system is built to be a two-way street.
So, let's do a quick recap. If there was a final exam on GST for online sellers, this would be your cheat sheet. Just remember these key sections. Section 24, that's your mandatory registration. Section 52, that's the 1% TCS. Section 16, that's your best friend, the input tax credit. Section 34 for handling returns with credit notes. Sections 37 and 39, those are your monthly filings. And finally, Section 54 for when you need to get a refund. Nail these, and you're in great shape.
And that really brings us to the most important question of all. It's so easy to look at GST as just another headache, another chore you have to do. But I want you to think about it differently. Is your GST compliance actually supporting your business's growth? Because when you get it right, when everything is clean and accounted for, you build this solid financial foundation. It means you can grow your business, you can scale up without ever looking over your shoulder. It stops being a burden and becomes one of the pillars that holds up your success.